Hello, and welcome back to Portfolio Matters. Weekly Markets Checklist, week 174. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So we've had a bit of a gap, Keith. What have we got today?
First of all, some news. So thank you all for your forbearance. We've taken a bit of a break. The reality is that this podcast takes me about 3 days a week to put together, including one full day to record it, publish it, and get it out there. So going forwards, we're going to move to a bi-weekly schedule so that I can do some other things in my life as well as doing Portfolio Matters. This Thursday, we are going to have drinks with Matthias from Germany, who is over 6:30, Princess Louise, High Holborn. Hope to see a few of you there. Okay, a lot has happened in the past month since we've been away. Number one, Donald Trump has been re-elected president of the US, and that throws an enormous bomb into the world economy, potentially. He is threatening to increase tariffs of up to 20% on all imports and 60% on Chinese imports. We'll go through his possible economic agenda in due course. China has unveiled a $1.4 trillion package to stimulate the economy, except it's not. Actually, it's largely a debt swap that will help bail out local authorities. The Bank of England cut rates to 4.75% last week, but says that the UK budget has materially added to inflationary pressures and will slow the path of interest rate cuts. We will go through the UK budget in some depth. The Fed also cut rates by 25 bips to a range of 4.5 to 4.75%. 2 weeks ago, Rachel Reeves, the new Labour Chancellor, gave her disastrous budget. Disastrous for me, that is. We will go through that. In Germany, the government has fallen and the German economy is not doing well. And finally, OPEC Plus has delayed its production increase by 1 month to January. Oil prices ain't doing so good. Some charts. This is the Bank of England interest rate. It's coming down, but given the budget, the path of interest rate cuts is likely to be slow. The bond market really did not like the budget, and that has been super bad for me. We'll go through that because it massively boosted spending in a way that Rachel Reeves had not prepared the markets for. So that came as a big surprise, leading to a big gilt sell-off, which remains. In the US, the Donald Trump's election led to a big jump in markets of all kinds, particularly Bitcoin and equities. The Fed, though, still cut by 25 basis points. And if Donald Trump raises tariffs as expected, and this time there will be fewer checks and balances on him and his agenda, then that means the Fed will be cutting rates more slowly. But for now, US interest rate expectations are largely unchanged. Inflation expectations, though, have surged following the election. Okay, and on to this week's economic data. Now, we have a month's worth of economic data to get through, and we are going to go through it really quickly because actually there's a great deal of uncertainty, and Donald Trump's election and his economic agenda could completely change the outlook. So where we are now is the UK economy is resilient but weak. The budget is expected to boost both growth and inflation next year, but its effect is forecast to fade in subsequent years. The EU is weak but stable. The US remains strong, though the labour market continues to show definite signs of weakness. China is weak but possibly improving. So first of all, the UK. And we're going to go through this very quickly. So inflation in the UK surprised to the downside in September, coming in flat, lower than expectations, lower than August, and that brought inflation down to 1.7% year on year, below target. Core also fell to 0.1%, 3.2% year on year, all of which was much better than expected. And good news was that that was low for September, which is generally quite an inflationary month. And also, services inflation started to fall. Now only 4.9%, still well above the Bank of England's target. And if you look at surveys of hospitality firms, inflationary pressures look weak. However, the Bank of England believes that the low September print was due to the volatile elements of the services sector, and it expects some of that good inflationary data to unwind in coming months. And the NIESR thinks that inflation will return to about 2.6% next year. RPI was negative in September, which is terrible for index-linked gilts holders such as me. It was 2.7% year on year. Good news though, input PPI was negative, both monthly and yearly. Output PPI was also negative, so that looks like inflationary pressures in the UK remain subdued. GDP in August was 0.2% month on month. Annually, it was 1%. So the UK economy is weak, but still growing. Onto the employment numbers, unemployment rate fell unexpectedly in August to 4%. But this comes from the labour force survey, and it just looks wrong to me. So the response rate for the labour force survey as of April was 18.5%. Weekly earnings, including bonus, falling to 3.8% on a steady downward track, but still far too high for the Bank of England. Excluding bonuses, way too high, 4.9% coming down, but still way too high. Now, from the labour force surveys, this just looks wrong. So the 3-month change in employment in August was 373,000, showing that's 1% of the labour force, suggesting the UK employment market was going great guns. But if that's the case, how come the claimant count is rising and HMRC payrolls are actually falling? And if you look at that chart, that shows a steady deterioration in job creation in the UK. So to me, it looks like the labour force survey is simply wrong. Industrial output was okay in August. Year on year, still poor, still falling. Retail sales, 0.3% in September. That's a pretty strong number. And if you look at the year on year, that seems to be a steadily rising chart as UK consumers have above inflation pay rises. Construction output was better, but still 0.3% year on year. The Labour government is going to boost construction in the UK. Manufacturing PMIs weakening again. Services PMIs weakening again. Overall PMI positive but weakening. Construction PMIs actually weakened though the trend is up, and the Labour government is going to put a lot of money into construction. Problem for Rachel Reeves is the PSBR was continuing to miss forecasts in September. Consumer credit, fine. Mortgage approvals, fine. Car registrations in September, quite much lower than expected at -6%. Higher interest rates disincentivize purchases of durable goods. Despite the higher interest rates, UK house prices continue to rise. And year on year, they're up 2.4%. This is the chart of UK house prices from the nationwide, down from their peak, but still rising. Economic Surprise Index for the UK, strongly negative, actually mildly negative, but falling. This is 1 week after the budget, and we have yet to see whether the increases in national insurance disincentivize job creation. We strongly suspect they will, but for now, the general trend remains down. So the UK summary, and I apologize for rushing through this so quickly. Inflation currently is below target, but expected to bounce back as we have the new energy bills coming through in October, and next year the budget increased consumer spending and will lead to higher growth and higher inflation. Wage growth continues to fall. GDP growth, 1% in August, is not strong. And the UK labour market statistics are just contradictory. We suspect the HMRC payrolls data is the correct one, showing weak job creation. And the PMIs show that the UK economy is weakening once again, and that is before the impact of the budget. Now, overall conclusion is that the UK economy is operating close to capacity, as evidenced by the low unemployment rate, and the economy is weak and resilient. But Rachel Reeves has now increased public spending, and the OBR is forecasting that that will lead to the UK having a negative output gap next year, which is inflationary. But also Donald Trump is going to potentially impose tariffs, and that will be bad for UK GDP growth. The NIESR estimates 10% tariffs would reduce UK GDP growth by 0.8% next year. They also say it would increase inflation. We have sections on that coming up. Richard, quiz of the week while we're on the UK. I suspect you know what this is, but we're going to ask you anyway. What is it?
Looks like a railway shed to me, Keith.
Well, this is pertinent to our previous quizzes of the week. And give you a clue, it's 1 kilometre long.
It's a railway shed.
It's much worse than that.
Is it some sort of clean energy thing? So that's what it is. Yes, it does. Cost 100 million, didn't it?
Yeah, it's £100 million bat shed. So
can we just have another look at it?
So it's been built to protect bats from the new high-speed rail link in just one wood, and it's going to cost 100 million. And according to the chairman of HS2, there's no evidence that high-speed trains interfere with bats. So there you go. And nobody takes into account the environmental impact of building £100 million. Well, was that made of stainless steel? Yeah. Bat shed.
No, they don't.
So, Rachel Reeves attempts to get infrastructure projects going, get investment going in this country. Yeah, good luck. Well, there's so many rules and regulations, And on to the EU. Richard.
Thank you, Keith. So CPI month on month. So CPI month on month, 0.3% in October. Year on year, it's 2%, just below 2%, below the target rate. Core CPI, 2.7%, down in October.
Yeah, but still persistent, isn't it? A bit too high.
Yeah. And EU GDP, quarter on quarter flash, 0.4%. Higher than consensus expectations. EU industrial production month on month, 1.8% up, better than expected. And year on year, very slightly up in August, but better than expected. EU construction output negative, significantly negative in August and worse than expectations. EU balance of trade, is it turning into a deficit? Question mark.
Well, if Trump imposes tariffs, that's super bad for the EU.
Yeah. EU economic sentiment, it's sort of very low in comparison to where it was pre-COVID, but it's flat in another sense.
Mm.
EU industrial sentiment, definitely on quite a sharp downtrend. EU service sentiment's fairly flat. EU consumer confidence is rising, but at a quite a low negative level. And the EU manufacturing PMI, pretty much flat, really. And EU services PMI looks like it's on a downtrend. Composite PMI, definitely on a downtrend to my eye.
Yeah, but 50, that's neither expanding or contracting.
Yeah, the EU economic surprise index is up at 18.1%, a lot better than last week. The German economy is responsible, as you can see there, for much of the EU weakness. The German economy is in serious trouble. EU GDP nowcast quarter on quarter is 0.4%.
Now, actually, this is the last week we're going to follow this because, frankly, they released GDP numbers 0.4%, which is decent. And actually, the whole period we were reporting this, we're forecasting -1, just nonsense.
Yeah, agreed. The German Indeed job posting index was actually up a little bit, but the trend is clearly downwards. German wage growth, a little bit stable at 4% at the moment, which is higher than the ECB would want. France job postings index also on a downtrend, and France wage growth falling sharply and continuing to do so. German unemployment has now risen for 22 months in a row, pretty much coinciding with Ukraine's invasion by Russia.
Good point.
German contribution to industrial production, 17% below 2017 levels.
Yeah, that's a pretty shocking looking chart, actually.
Yeah. Chinese car exports have become a leading cause of the decline in German industrial production, as we've read in the news recently. Basically, China is in the process of decimating the German car industry. And French and Italian fiscal deficits seem to be out of control. Is there a plan? Ask Ursula.
Mm.
And France has not yet passed its austerity budget. That was Michel Barnier that would cut the fiscal deficit from 6.1% to 5% by the end of 2020.
Yeah. And the thing is, you've seen the French wage growth. France is in trouble. If they now pass an austerity budget, it's not going to be good for the economy.
French bankruptcies, 12-month cumulative, is on a steep upward trend for the last couple of years. So this is growth expectation. So I just need a long term. So this is a 5-year GDP growth expectations from an ECB survey. And as you can see, it's not looking good.
Yeah. So to me, this means that EU interest rates have to fall. They need to get inflation under control, and then they need to cut interest rates hard.
So the Eurozone economy is weak but resilient, and although I'm not sure that it's going to remain that way personally. Inflation sticky, with a core at 2.7% in October. PMIs not really showing much change. But of course, the EU exports lots to the US and may be badly hit if Donald Trump imposes his threatened tariffs.
And on to the US. So, non-farm payrolls for October were a big miss. Only 12,000 jobs created, well down on September, which of course was revised down, and well below expectations. And if you look at the sector by sector, you'll see the government still creating jobs. October jobs number was affected by strikes and hurricanes, but there was a broad slowdown in private sector job creation. Let's see what happens in November. Now, Goldman Sachs estimate that if you strip out all the noise, the underlying trend in payroll growth has fallen to about 150,000 a month. So still creating jobs, but slower than it was. Every month they revised down previous numbers, and they did so again this time for both August and September. Now, one of the puzzles is that job creation, according to non-farm payrolls, has continued to climb even as surveys of employers show that their employment intentions have been declining for 2 years now. The Employment Trends Index has 8 components. It's in the box on the right. Have a read. Construction jobs, according to the BLS, continue to rise even as new housing starts have fallen, and according to JOLTS, the number of job openings in the construction industry has fallen. How does that work? Manufacturing jobs fell sharply, and that may well be due to strikes and hurricanes, but reminder that in January they're going to revise down the whole non-farm payrolls series for this year because they have reconciled it against the census, and unsurprisingly to regular viewers, it's far too high. Now, over the past year, if you look at the household survey, then the economy has lost 1 million full-time jobs, and all the employment growth has been in part-time roles. And if you look at the red line, which is the household survey, total employment fell by 368,000 in October. And there's this enormous and growing gap between the household survey and the establishment survey. Remember, an employed person who earns no money because they are absent from work counts as employed in the household survey, but non-employed in the establishment survey. So the household survey should actually not be affected by the strikes and hurricanes. If you're home from work because you can't work, you're still counted as employed in the household survey, and it showed 368,000 job losses in October. The background is steadily declining payrolls growth. Weekly earnings remain strong, 4% year on year, still very good. And if you look at union jobs, payroll growth is really strong. So that is inflationary. As worked, fine. Unemployment rate actually ticked down, although the trend remains up, as evidenced by this chart. The unemployment rate ticked down, although I think you'd still say the trend was up. GDP in Q3 was 2.8%, the US economy doing well, and that's largely being driven by consumer spending on goods and services. The US consumer continues to dip into their pockets. Real consumer spending in Q3, 3.7% annualized. Inflation is coming down. In Q3, PCE inflation was 1.5%. Very good. Core PCE, 2.2%, just a tad above target. And the US economy is growing productivity, which means it can afford higher wage growth. If you look at the labor cost index, it's only 1.9% annualized. PCE inflation month on month in September was 0.2%, year on year 2.1%, fading towards target. Core 0.3%, too high, and core 2.7%, still too high and not coming down as fast as the Fed would like. But if you look at the trimmed mean, then it is coming down slowly, and the core CPI of 2.5% in September was rounded up to 0.3%, so it's all noise. The background is that core CPI, we've just reported PCE, but here we're looking at CPI. CPI numbers out later this week. CPI, most of it is shelter. So as shelter, the OER operates with a lag, which we've talked about many times. As that comes down, US inflation should come down. That's before Donald Trump gets to work. Income, decent. Personal spending, very good. Job openings continue to fall and have been revised down. That is a rapidly declining chart. And the job postings index on Indeed continues to fall. So reporting this for the first time, this is US jobs market data from the website Linker Up. And what it does is it looks at the top 10,000 employers by the number of job openings and produces an aggregated number of job openings. So the daily number looks at the past week. So job openings over the past week. Monthly looks at the past month. And so the constituents will be different in the weekly, the daily and the monthly. And you'll see the daily is showing really a very rapid decline in job openings, job postings over the past month. Now, we haven't got the latest monthly data for that period, but something to watch. And the slowdown in job postings is broad. Job postings per unemployment person are almost back to one to one. That's good news for inflation. Quit rate continues to decline. Layoffs rose in September. The hiring rate picked up, but only back to actually quite a poor number. The ADP employment change actually completely contradict non-farm payrolls, and the JOLTS data we've just shown you in showing October being a strong month. Retail sales strong, year on year, 1.7%. Never bet against the US consumer. They've got growing income and they are spending it on goods and services, less on durable goods. Industrial production is weak in September and not doing so good. Higher interest rates are disincentivizing durable goods consumption. Factory orders in September poor. Construction spending, actually, it's flat now. The weakness in June and July has passed. The Chicago Fed National Activity Index for September showed the US economy operating at below average, and it's been doing that for much of the past year, despite the US economy being actually fairly strong. Manufacturing PMI strengthened but still weak. Services PMI okay in October, still strong. Composite okay. The US economy continues to do all right. ISMs had a different picture. Manufacturing PMI weakening, services PMI strengthening strongly, and that is a good number. The Michigan consumer surveys, sentiment still poor, current conditions still poor, inflation expectations fading, but still at 2.7%, 5-year expectations at 3%. Building permits are actually, they're weak, but not deteriorating. Housing starts remain resilient. Existing home sales continue to fall and the recent bounce in mortgage rates will only make that worse. New home sales, though, mystifyingly, continue to rise despite terrible home affordability, and in the coming weeks we will revisit the US housing market. House prices, is the recent surge starting to fade? Still up 5.2% year on year. Housing affordability, just awful. Higher interest rates, and this is before the recent surge in interest rates. Initial jobless claims, not really rising week on week, but if you are out of a job, you are finding it very difficult to get a new one. Continuing jobless claims continuing to rise. On to the nowcasts. Dallas Fed 1.7%, Atlanta Fed 2.5%, both of which are slightly weaker than Q3. New York Fed 2.06%, again weaker than Q3. St. Louis Fed 1.77%. So according to the nowcast, US economy still doing okay. Economic supply index rising strongly. Trueflation, oh dear, that's not looking very good for the Fed. Now, the reason the US did not go into recession, despite the sharp rise in US interest rates, was that investment, the red line, has continued to rise, thanks in parts to the CHIPS and IRA Acts. Higher interest rates did not discourage investment. But if that is a secular shift into investment in AI, etc., when that passes, the economy should slow. The fiscal deficit remains out of control. Red line spending, blue line tax revenues. The gap between the two is enormous. Donald Trump is going to do nothing to bring the two lines closer together. In Q3, the deficit was 6.3% when the US economy is doing well. Shocking, frankly. And neither candidate has plans to fix it. Actually, now we know Donald Trump has got in, and Donald Trump is by far the higher of the two. He's just going to add to the deficit. And all that means net interest payments are skyrocketing to 1.12 trillion annualized in Q3. So, US summary, bottom line is US summary, US economy is doing well. Frankly, the jobs market is slowing, but let's see what Donald Trump does. If he is planning to raise tariffs, which would be inflationary, and he is also planning to deport lots of illegal workers, which would also be inflationary. There is a lot of uncertainty about the future path of the US economy. If he cuts taxes further, then that is stimulative. Richard, China.
So China GDP quarter on quarter is fairly steady, nearly 1%. And year on year GDP, 5%. I mean, it always is, isn't it? It's just below 5%. China inflation month on month at 0. Year on year, it is actually heading down towards 0 and it's very low.
Yeah, which does not suggest strong demand pressures.
No, completely, yeah. Core inflation month on month negative in China, and year on year core inflation nearly at 0. China industrial production year on year 5.4% and looking very healthy.
Yeah.
China composite PMI 50, fairly steady at 50. And the Caixin composite PMI 52, just rising slightly. China fixed asset investment year on year 3.4%, and retail sales year on year 3.2% up from August and looking quite healthy. China unemployment rate seems pretty stable at 5.25% or so. China newly built house prices year on year continuing to fall hard, down 6%, nearly 6% in September.
Yeah. Yeah, this is a big number to me. You know, they're not, bottom line is they still have a housing crisis.
Yeah.
The aftermath of a property bubble.
China new vehicle sales year on year looking very healthy, actually. And China balance of trade at 95 billion positive is good for China, but not necessarily good for the rest of the world.
Yeah, and you know, the big problem for China is if Donald Trump puts in tariffs of 60%, then they are in big trouble.
Yeah. China exports year on year up 12.7% and growing quite strongly.
Now, I wonder whether importers haven't put in big orders in the US to get ahead of possible rise in Trump tariffs.
Quite possibly, yeah. And China imports year on year, quite noisy, but around about 0 change.
Yeah.
China loan growth year on year continuing to fall sharply, although the growth is 8%. China foreign direct investment year on year has fallen very sharply, and has it stabilized? We don't know. Down 30% year on year.
Well, falling 30% year on year means it's going to rapidly approach 0.
Yeah. And China has an awful lot of debt, this chart shows.
Yeah. No, that is the problem, Richard. You know, they've got a bursting of a debt bubble. They need to deleverage. And the Chinese government stimulus of 1.4 trillion, as announced last week, I mean, frankly, they're just shuffling the numbers around.
And this is the property market, effectively, isn't it?
Yeah, but also, you know, the local governments have just got loads of hidden debts. That's so the stimulus, the central government is issuing debt to try and take some of the hidden debt off the local government's books, or allow them to deleverage.
Yeah, ultimately it'll have to be written off. New home sales rose for the first time this year in October in China.
Yeah. I doubt it will be sustained, frankly.
Yeah, so we need a trend, don't we?
Yeah.
So summary of the Chinese economy, it appears to be strengthening, led by the export sector. The housing market remains weak. Obviously, there may have been a surge in export orders. If Trump puts these tariffs on, it's going to cause real problems for the Chinese economy.
Great. Thank you, Richard. On to one chart. Now, we've shown you this before, but we are getting rapidly to the point where the falling US job vacancy rate should start to cause higher unemployment in the US. So the Beveridge curve is on the right-hand chart, and you'll see that the vacancy rate continues to fall. Now, the vacancy rate is total job vacancies over total employment plus total job vacancies. And so falling job vacancies mean the vacancy rate's falling, and it should start to cause higher unemployment. Actually, the trend in unemployment is definitely up. So although the US economy is doing well, the employment market is continuing to weaken. Let's see what happens when Donald Trump starts to execute his economic agenda, he says. Now, on to the UK budget, Richard.
Thank you, Keith. The UK budget wasn't what we expected during the election campaign. It became a little bit more like what we expected when Rachel Reeves started to soften us up. But it wasn't what we expected in terms of the quantity of additional tax revenue they're trying to raise and the additional debt that they want to take on. So employers' national insurance to rise by 1.2%, which won't affect the employed person, the worker, as we need to call it, apparently. Threshold at which national insurance is paid fall to £5,000. Government forecasts will raise 25 billion a year. And that's a huge impact on business. Income tax thresholds frozen again. And apparently in 2008, there were 1 million people, roughly 1.4 million people in paying higher rate tax. In 2028, it's projected to be 8 million people because of freezing of the higher rate tax threshold. Capital gains tax higher rate increased from 20% to 24%. Inheritance tax, pension assets will be included in inheritance tax. And business and agricultural assets to be taxed at 20% above £1 million, which the farming community is up in arms against. And actually, you know, the succession planning for small businesses has been seriously hit here. I did, if I can, am I allowed to make an aside here, Keith?
Sure, of course.
So the government business secretary has never really had a proper job in his life. How can the business secretary, who is supposed to advocate for business, never have had a proper job? And none of the government front bench have had their own business, worked. You know, they don't know what they're doing in terms of what is the mainstay of this economy. Other non-dom states abolished, VAT on private school fees, consequences yet to be determined, and private equity carried interest tax at 32% up from 28%.
Yeah, so big tax rises.
So the NHS will receive an additional 22.6 billion, and housing will have 5 billion spent on it in the year 25-26. HS2 will be terminated at London, and the concept of terminating it anywhere else was bonkers.
Yes, absolutely. That's a good thing, frankly.
Yeah. Public investment, the the fiscal rules will be changed to target public sector net financial liabilities, which recognises the benefits of public sector assets. Basically, they just want to be able to borrow more money.
Well, the trouble with that, Richard, is that it basically allows the government to spend an infinite amount of money as long as they spend it on assets.
And it's also, it's not, public sector assets aren't necessarily revenue generating, but it's
Exactly.
they are. So it's based on a false premise.
Well, but you could also argue that it brings a lot of government off-balance sheet debt onto the balance sheet in the way that, previously, let's say the Blair government did lots of these, was it PPI, public-private investment, where essentially, private equity built a hospital and then charged the government 10% a year. Now that debt,
and still
a liability of the state, and the expense was enormous. Whereas now the government builds it, and they charge 5%, the cost of the debt, basically. So actually, it's not daft, but changing the rules, the limit should be, sensible spending, basically.
So the government borrowing rules are new rules to not has set itself a rule not to borrow for day-to-day spending, and the current budget will therefore be balanced within 3 years. And the government will run a deficit of 26 billion in 2026, will achieve a surplus of effectively 11 billion in 27-28, and stabilising at about that figure going forward. So public sector net debt, they say, will fall from 127 billion in 2024 to 70 billion by 2029. I do not believe it.
No, neither do I. We're just about to go through the OBR's assessment of the budget, actually. But on the day-to-day, the new rule is that they won't borrow for day-to-day spending. The trouble is that's a very pro-cyclical rule, and there is no contingency for the fact that the UK economy is currently weak but expanding. If the UK goes into recession, that rule would suggest they need to raise taxes to balance the books.
Yeah, I mean, my view is that we've got to the point now where the tax level is suppressing economic activity and will do so. And government actually needs to step back and spend less, not more.
Well, when we next week, well, I'm saying in 2 weeks' time, when we do this again, I'm going to be very interested to see how the job openings are, because I would, lots of businesses have come out saying that they're facing a 6% increase in costs, and that they're likely to reduce workers, and companies are likely to go bust. So let's see what happens, because the big assumption is that she can just stuff loads of costs onto employers rather than employees and not change their behavior.
I mean, fundamentally, the private sector will adjust by employing fewer people, so its wage bill stays the same. That's what it will do, and obviously that's going to affect unemployment. But there's this complete deficit in joined-up thinking, in that if you increase costs on business, nothing happens.
Well, it's a wishful thinking, and bear in mind they've also changed the employment laws to make it harder to fire workers and give them employment rights from day one, all of which deters hiring. And I read the Angela Rayner's letter to the FT, in which she was arguing that these rules were good for business. Only in her head are they good for business.
Well, they don't understand, do they? Because they've never run a business. They don't know what it's like.
Okay, and on to the OBR's assessment of the budget. Richard, do you want to chip in whenever you have something? Yep. So, bottom line is that when Rachel Reeves went up to speak in Parliament and deliver the budget, gilt markets were impressed. Gilt yields fell. But she had not been honest with Parliament about the increase in spending. When the OBR gave their assessment of the budget, there was a huge sell-off in gilts. Rachel Reeves had not prepared markets for the big increase in spending. As a result, UK gilt yields are what look like to be permanently higher, which will increase pressures on the budget and was super bad for me, all of which we'll go on to in due course. So the bottom line was UK public spending will increase by 70 billion a year. Like that's 2% of GDP. 2/3 of that will go on current spending, 1/3 on capital spending. Half the rise will be funded through taxes. You've seen how large those tax rises are. The remainder through extra borrowing. Borrowing will rise by 19.6 billion in 2024, 32.3 billion each year for the following 5 years. The OBR assess that all that extra spending will temporarily boost GDP in 25-26, but then have no effect. So this is from charts from the OBR, and they show how those taxes and extra spending will result in an increase in the deficit. The black lines are the public sector net borrowing requirement. You'll see that in coming years, it continues to drift up. The yellow bars are taxes, but all that will have quite a limited effect on GDP. Next year, the measures will boost GDP by about 0.65%, but then you'll see crowding out and discouragement have a negative effect on GDP, which increasingly balances the increase in government spending. The boost to GDP is actually going to cause a negative output gap, according to the OBR, in 25-26, which will be inflationary. As shown here, inflation is forecast to rise next year to 2.6%. Interest rates will stay higher for longer. And according to the OBR, interest rates are forecast now fall to a low of 3.5% in 27. None of this, all of these forecasts, of course, assume the UK never goes into recession. Let's see whether Donald Trump imposes 10% tariffs. Public sector borrowing requirement, this is net borrowing, should come under control, but successive governments have always fudged the figures in due course to keep on borrowing. So previously, the Conservative government was going to get the going to bring the deficit under control and towards 1% by 28-29. The new Labour government has that at 2.1%, so increasing the PSBR by about 0.8% apparently. Sorry, 0.9% in 29-30. The left-hand chart shows the forecasts under the Conservative government. They were forecasting a net borrowing of 1.2% of GDP in 28-29. That's now 2.1% under Labour. Taxes continue to rise to a post-war high. Reminder, they're frozen tax thresholds. The tax take will continue to rise. Public spending is higher. The public sector net debt, and you're looking at the blue line, stabilizes but does not fall. So the OBR estimates that the government will currently hit its rule of having a balanced budget for day-to-day spending actually quite quickly in 27-28. So that actually is good news. And when you compare that with what's happening in France and Italy and the US, that makes Britain actually quite fiscally sensible. But obviously the tax rises mean that business investment falls while government investment rises. So in our view, it's a classic Labour tax and spend budget. It boosts government spending at the expense of the private sector. The delivery in particular was very badly handled. Rachel Reeves should have primed markets, particularly after what happened with Liz Truss, to expect the big increase in government spending and borrowing. She didn't. The gilt markets took fright and yields remain higher. And I am in particular worried by this balanced budget rule. It's potentially very strongly pro-cyclical. But of course, they say they're going to have a balanced budget rule. When it comes to push comes to shove and the UK goes into recession, I very strongly suspect they will relax it. Richard, your thoughts?
I think you're completely right, Casey. I mean, the problem is that this is it's a budget that assumes that there will be no impact on business activity by the stonking national insurance increases and a minimum wage increase, which is massive for businesses that employ relatively low-paid people, and the employment changes in employment rules. It assumes that there will be no impact on business there. It assumes actually that by putting all this money into the public sector, they'll achieve what they want to achieve, but actually they need to change the way they do things, and I don't think they'll do that. And it assumes, well, it assumes there's no tariffs, assumes there's no recession, and I suspect that the whole thing is not sustainable, and that they will not achieve their objectives. I think it's actually in cloud cuckoo land. The last point I make is that they went into this election with a great sort of fanfare that they're pro-business, and they come out of the budget showing that they're anti-business. And it's private sector businesses that create the country's wealth. So, they are, in fact, just as bad as the Labour governments of the 1970s, 80s, and 90s. Sorry.
Yeah, well, the bottom line is the budget has led to significant monetary tightening.
Yeah.
So this is the 5-year reminder. Most mortgages in the UK are 2 to 5 year fixed, and pre-budget 3.7%, currently 4.3%. So you've seen, what's that, a 15-20% rise in the interest rates for mortgages pre and post budget. That is very bad for young people and for debtors, and actually for the government itself. And it's when it says it's going to balance the books, including interest costs, well, it's made its own task more difficult.
The other thing it's got to do is, increase capital gains tax, carried interest, by 4%. It's going to increase them by 4% in the next year or 2 years' time, and they're just boiling the frog, and they are I think this country's actually reached a point where any additional tax raising effort is totally counterproductive to the economic health. And also that people have got to the point, and about you, Keith, I've got to the point where I just think that, we're being taxed to death. And one acknowledges that you need to pay for public services, but when it's done so badly, so cack-handedly, and it was done that very cack-handedly by the Tories, no doubt about that.
Yeah, agreed.
It's a complete shambles, and this government can't fix it.
Well, the thing is, they want growth, but then they're strangling growth. The weekly quiz, 100 million on like a bat tunnel through it's just daft. How can we grow and produce any investment in this country when we've strangled ourselves in so much regulation?
I don't know, Keith.
Yeah.
And they're putting more in place, not less.
Yeah, well.
France, here we come.
Well, and that brings on to me, and so I have a huge mea culpa now, because I obviously went big into guilt in the expectation that we couldn't have stagflation, which was Richard's point. Richard thought we could. I didn't think we could. Because, the reasons for my disastrous oversized position in long-dated gilts, and non-spoiler alert, the reason we've taken a break is, frankly, I was just too depressed to do the weekly, but I've now kind of got over myself, is that I thought that inflation would rapidly return to 2%, and interest rates would fall sharply, and with the bond yields, well, I've been kind of largely right on inflation, absolutely wrong on interest rates. I thought the sharp rise in interest rates on both sides of the Atlantic would kill the economies, leading to an recession, which would mean sharp drops in interest rates. Been wrong, totally wrong. I thought that the UK economy, which has very low productivity, and that the sustainability of interest rates is essentially a function of productivity. Low productivity means low interest rates. Well, UK remains low productivity, but interest rates are higher. And finally, I did not think stagflation was possible because, and we've had this debate between Richard and I on the podcast previously, my argument was higher inflation would lead to higher interest rates, which would slow the economy, which would slow inflation. And then the Bank of England would cut rates, and you have a self-normalizing economy where interest rates are set by the economy and by productivity, i.e. lower. Now, what I missed was that, yes, you can have stagflation. You can have stagflation if the government interferes with the price mechanism to force prices higher. And frankly, that is exactly what happened in the budget. The government has imposed 5.5% public sector pay rises, well above inflation currently. It's also set the minimum wage next year at 6.7%. It is mandating wage inflation. It's also raised business taxes, not personal taxes. And there's a crucial difference between the two. If you raise personal taxes, you reduce personal spending, you reduce demand. If you raise business taxes, businesses will attempt to pass those higher costs on through higher prices. That is inflationary. The government has also increased public spending to the point where the OBR estimates that there will be a negative output gap in 25-26, causing inflation. All of that means the market is worried about higher inflation and permanently higher government borrowing, and that means higher gilt yields. And all that to provide a temporary boost to the UK economy. So what that means for me is that I have been totally stuffed. I've been totally wrong. UK inflation's higher. Bond yields are much higher than they were. And as long as the government keeps on mandating higher inflation in the form of higher wages, minimum wages, and higher public sector wages, then inflation, we can have stagflation. Reminder, the UK economy is growing at 1% a year. We're not growing strongly. And in order to boost investment, private sector investment, then you need interest rates to come down. Now, you can boost investment from the public sector because the public sector can always pay its interest bill. And currently, that's where we are. So, medium term, I still expect interest rates to fall because we remain a low productivity and aging economy. But it's clear it's going to take a long time, and I'm going to be stuck in this disastrous investment for a long time. I just need to deal with that. But I kind of got over myself. I've lost a lot of money, and we will be doing the weekly, well, sorry, the bi-weekly from now on. Any thoughts, Richard?
Yeah, I'm quite depressed by it, really, Keith. I agree with your the analysis that you've just run through. I think all the Western economies are over indebted, apart from Germany, which isn't over indebted,
Yes.
but may well become so. I think that Europe and the UK are not in a great place, and we need to move away from big government. I am fundamentally a libertarian. We need to move away from big government, and until that happens, these problems can't be solved.
Well, I think you're in for a difficult 5 to 10 years, Richard, because You know, the I don't think the Labour government's very popular, but the Tories have just put in Kemi Badenoch.
Yeah,
They're not moving to the centre, and you win UK elections by moving to the centre.
yeah, well, I agree. It's all major. But anyway, there's another 4 years effectively this government to go. They've got
Yeah.
a lot of time to continue to mess up the economy. Whether they can fix things like the NHS, I think is an open question. If they want to fix it, it needs fixing. Whether they can do it, I don't know. I suspect it's too hard, and they won't succeed. But they may.
No, that's one of my fundamental problems with what they've done is they're just chucking more money at the problem.
Yeah,
It needs fundamental reform.
yeah.
But they're not going to do it. They're just going to chuck money at it. And on to the US, Donald Trump's economic policy. We should have like the Jaws theme running.
Yeah, the thing about this, Keith, is we don't really know what his economic policy is yet.
That's true.
Because he hasn't appointed his senior, or he hasn't told us who his senior officials will be, and that gives us an indication. Obviously, he has sort of indicated things he'd like to do, but not everything Trump indicates he'd like to do did he do in his first term. So
that is true. But anyway, do you want to do this?
Yeah, sure. Yeah. So Trump, up to this point, there are sort of basically three key things that he says he wants to do, which is big tariffs on imports from China, tariffs of between 10 and 20% on all other imported goods, tariffs on goods imported from Mexico, because a lot of Chinese goods have already sort of been imported via Mexico to get around tariffs that already exist on Chinese goods. So it's tariffs, tariffs, and tariffs, and he wishes to raise a lot of tax revenue by that. He wants to cut personal taxation, doesn't he? And I suspect his mind is sort of saying, in his mind, he's thinking we increase tariff taxation, we cut personal taxation, and everything is neutral.
I think that's exactly his thoughts.
Yeah. But of course, it's bad for world trade and very bad for exporting countries. It's probably bad for US inflation, but of course, if he cuts personal taxes, it may. I'm not sure how that one works out, to be honest. Yeah, likely to lead to retaliatory tariffs. So my query on all this is, he was effectively elected by the working class, and if his policies are demonstrated to him as being bad for the people who elected him, I'm not sure that he will persist with them. So I do think the jury's out a bit on this one.
Actually, Richard, I don't. I think he will raise tariffs because it's been a key part of his agenda.
Yeah.
And his huge election win, and it was enormous. I think that's just going to convince him he's right on everything. Yeah. And the last time he raised tariffs, everyone's going to tell him that it's bad for US inflation, etc. But last time he raised tariffs, there really wasn't that much of an effect on inflation. You go back to 2016, inflation was fine.
And Biden kept them in place.
Yeah, exactly. So although the economists are going to be saying, you shouldn't raise tariffs, it's going to be bad, he's going to say, well, I raised tariffs last time, it was fine. So yeah. I think he's going to do it.
Yeah. Taxes. So Trump is a tax cutting.
I'm going to keep that in. That is the best Freudian slip I've heard all year.
Trump is a tax cutting president, and he's proposing a variety of new and existing tax breaks, which are listed here, and including reducing the corporation tax to companies, US companies that manufacture in the US. As we know, tax cuts bad for fiscal balance, but we've got the debt levels. If he coincides it with the tariffs, then the tax take may actually sort of be the effect on tax take may be neutral. So I think it's very difficult. Personally, I think it's really difficult to know what sort of effect all of these proposals are going to have on the US economy.
Well, absolutely. I completely agree with that. The question, he says so many daft things, and he actually, reality is last time he didn't do too many. He didn't actually execute many of them. So let's see.
Yeah, exactly. And he has it's the third major thing he wants to do is increase the volume of housing that's available and to release tracts of federal land for housing development. And also by deporting millions of illegal immigrants, that would obviously go some way to resolving the US housing problem and presumably force US housing prices down as well.
Yeah, absolutely. We'll do something on the US housing market in coming weeks.
Yeah. I mean, the only other thing, I don't know whether there is any data on it. I don't know what the effect of illegal immigrants working in the US economy is in terms of the labour market, how much it has loosened the labour market.
Yeah.
So, as Keith says, Trump says a lot of things he doesn't mean. He is definitely likely to be pro-business. He may well be fiscally irresponsible, but also I think that rather depends on the strength and efficacy of his advisors.
You have more faith in the checks and balances on Donald Trump than I do, Richard.
Yeah. Well, maybe it's misplaced, Keith. I don't know, but yeah.
Well, every time I've thought, in the last 10 years, I have thought, no, the population is going to be sensible. I've been totally wrong. So, Donald Trump elected first time, Boris Johnson elected this, second time. I admit that actually there's a terrible choice. Whoever you chose in that election was going to be a disaster.
Yeah. Well,
Brexit, Donald Trump second time, populism. Honestly, I think it's the effect of social media, polarizing the populace.
you may well be right. I mean, also I think that there's a big groundswell of unhappiness in the US, isn't there? They're very unhappy with the Biden administration.
In the gilts market, there's also a lot of unhappiness, frankly.
Yeah.
Anyway.
Yeah, exactly. And there was a huge groundswell of unhappiness against the Tories.
Yeah.
So what would be the effect of 10% tariffs on the UK? So the Centre for Inclusive Trade Policy suggests that UK exports to the US would be reduced by 22 billion at a 20% tariff rate, or a reduction in UK growth of 0.8%, 1.4%, and would raise it. So basically, the general sense is that the UK exports would drop to a economically significant extent. And the other unknown here is how every other country in the world would respond to US tariffs and what that would do to our other export markets. And indeed, would we then start raising tariffs for imports? And where does it go?
Now, remind a few weeks ago, we did something on the Smoot-Hawley tariffs of the 1930s, which exacerbated the Great Depression. And so the way other countries reacted to the hike in US tariffs in that period was they imposed retaliatory tariffs on the US, but then cut tariffs between themselves. So I strongly suspect the same would happen. That actually the US, you would have a reduction in trade with the US, but I don't see any reason to expect general increase in tariffs between other countries. You could actually see increased trade between other countries around the US as they jig their supply lines.
Yeah, quite possibly so, Keith. Yeah.
And that brings us on to the UK trade with the US. What is it? Well, actually, sadly for us, the US was the UK's largest trading partner in the year to Q2 2024, accounting for 17.6% of total trade. I take it that means by country, the EU as a whole is probably our largest one. So here we go. UK exports, number one, United States, 192 billion, 22% of our exports and services. Big chunk. Imports, 13.2%. You'll notice we exported a lot more than we imported. We are one of the countries running a big export surplus to the US, and hence, frankly, we're probably in the line of fire just about with everyone else. So in 2023, we ran a positive trade balance of 71.4 billion with the US, and given the UK trade deficit is normally terrible, that makes them one of the few countries we run a surplus with. So US tariffs not good for the UK balance of payments. And when we look at what we exported and imported to the US in the year to Q2, well, we exported pharmaceuticals, cars. I take it that's, high-end cars, Bentleys and Rolls Royces. I thought that was odd. Mechanical power generators, intermediate, we both imported and exported them. What on earth is that? If you know, please write in. But the other thing we really imported from the US was crude oil and refined oil. And when we talk about the effect of tariffs, well, if there were retaliatory tariffs on US exports, we'd simply buy our crude oil from somewhere else. Have no effect on the price whatsoever, as far as I can see. And within services, it's mainly business services. Not sure what that is. So the bottom line is the NIESR is forecasting US tariffs would add strongly to UK inflation. And I'm just skeptical about that because they're only 13.2% of imports. And if we impose retaliatory tariffs on US imports, things like oil, we just buy from somewhere else. There'd be strong substitution effects throughout the supply chain. We would just be buying more stuff from the EU and China, frankly. Now, as an exporter, we would definitely suffer. No question. That would be bad for the UK economy. But on inflation, I'm just not sure that's true. What do you think, Richard?
If we import, would we put tariffs? I mean, another question is, would you actually put retaliatory tariffs on? Would that be a sensible thing to do? In fact, because would you not be cutting off your nose to spite your face? I think. I think the whole thing becomes very messy, very unpredictable, and that the effects are likely to come and go in waves as countries adjust to the situation. I think the thing you can be reasonably certain of is it will be bad for the global economy and bad for individual economies around the world. But how the effect will flow through, how they'll ripple through, I think it's really difficult to say.
Yeah. The thing is, the British government will undoubtedly be sending delegations, saying, please don't impose tariffs on UK exports because of the special relationship, etc., etc. But then Labour, the Foreign Secretary, has written articles calling him a total toe rag.
Yeah.
And
we sent 100 odd
exactly
campaign activists to campaign against Trump.
Yeah, I can't see him taking either of those terribly well.
Yeah, that's just an extraordinarily stupid thing to do. I mean, it's just bonkers.
Yes.
Anyway, be interesting to see. This is an aside. Be interesting to see whether Trump decides to try and prosecute the various members of the Labour Party for interfering in breaking US electoral legislation.
Yeah. I prepared a segment on the effect of all this nonsense, this economic nonsense on UK young people. But we don't have time this week. We will do it next time. And on to Inflation Watch, Richard.
So we've got the inflation updates for UK. CPI down 1.7% in September, US 2.4% down, EU 2%. It was October, was slightly up. Japan 2.5% in September, and China 0.4% in September, all down except the EU. And then core CPI down in the UK, up in the US, unchanged in the EU, down in Japan, down in China. I think the thing of note there particularly is that core CPI in both the UK and the US, 3.2, 3.3% are higher than the central banks would like.
Yeah, now that's absolutely right. And so basically low inflation is being caused by big drop in energy prices. Now, one of the things Trump will do is he's going to let the shale drillers loose.
Yeah.
But oil prices have been falling. I really question how much extra drilling shale oil drillers want to do when oil prices are already this low.
Yeah.
So I don't think energy prices are going to rise, but I don't think they're going to drop much further either.
That's an interesting point, Keith. And then we've had a few interest rate adjustments in the downward direction over the past few weeks.
Yeah. Sorry, do you want to do that again? I've skipped on. Go on.
Yeah. So, and we've had a few interest rate reductions in the last couple of weeks in the UK, the US, and the EU as well. And they all dropped their rates by 0.25%.
Yeah, but unless core comes down, the pace of interest rate cuts is going to really slow from here.
So housing and auto insurance are the sole causes of US core PCE inflation remaining above target.
Yeah.
Just housing many times before, and the fact it's a lagging indicator.
Yeah. So really, in the US, everyone's talked about, resurgent inflation. There's not much to worry about currently.
Yeah. And Goldman forecasting US inflation will fall below 2.2% by the end of 2025.
Yeah, this is obviously before Donald Trump gets to work.
Yes. And I mean, that's a caveat on all of this, isn't it?
Yeah, absolutely.
Service inflation in the US, which is the blue bars, is continuing to fall, and underlying inflation looks quiescent. So, US inflation currently under control. So, the only the main unknown quantity is the effect of Trump's economic policies once he gets into power in January.
Yeah. Okay, thank you, Richard. Briefly on to recession watch. It is a terrible time to buy a house because US house prices keep on rising and interest rates have risen. The market rates have risen strongly over the past month. So 87% of US consumers think it's a bad time to buy a house. The crisis in US office space has not gone away. The commercial mortgage-backed securities backed by offices, the default rate just continues to rise, highest since the GFC, and that trend shows absolutely no sign of slowing down. US interest rates on credit cards just hit a new high. Poor consumers in the US are suffering, and hence it's one of the reasons Donald Trump did so well. And interest rates do matter, and they've been rising. So this is the interest expense on debts in the S&P 500, where companies have locked in lots of low interest rate debt during the financial crisis, but that's now being slowly refinanced at higher rates. Russell 2000, 7.1%. Higher interest rates, bad for small companies. We've really cut down the additional charts this week because we've got so much to get through, but normal service will resume in due course. Poor US households continue to struggle. There's little sign of a recession in the US currently, although the jobs market continues to soften. Good news. This is New York, which has hit its goal of installing 6 gigawatts. That is a lot of solar capacity, enough to power 1 million homes 1 year ahead of schedule. So they've raised their target to 10 gigawatts by 2030, and they've already got 3.4 gigawatts planned. So we are seeing this huge transition to renewable power. But Donald Trump is going to impose 60% tariffs on Chinese goods, apparently, and all these solar panels come from China. So what's going to happen.
Yeah, indeed. Do you know that the energy return, well, we discussed this previously, the energy return on solar panels is something like five times. That's in a good location. And on nuclear power, it's over 100 times. The other, do you know, also, as a little bit of an aside on this, Germany has suffered from foggy, windless weather for the last 3 or 4 days, and its renewable generation has basically slumped to virtually zero.
Yeah. Well, the thing is, Richard, one of the ideas behind my gilts trade was that the UK investments are just really low productivity. We are investing in wind and solar, and as you point out, they're very low productivity. So, basically, low productivity means that you have to have low interest rates to be able to afford them. Unless, and this is where I have been wrong, the government simply doesn't let the market equilibrate and they're not funded by the private sector. They are funded by the government mandating much higher prices to be paid by consumers, which is what's been happening. So,
which is a tax.
It's a tax, yes, but it's a hidden tax.
Yeah.
And on to equities, Richard.
So just run down the year-to-date changes. So the FTSE All World up nearly 19%, and the FTSE All Share up only 4%. Stocks Europe 5.8%, S&P 500 nearly 26%. Russell 2000, pretty good performance actually, 18%. Yeah. Nasdaq 28%. Hang Seng 21%, Topics 15, nearly 16%. Bitcoin up 90% on the year. Today, the pound against the dollar pretty much unchanged. The euro against the dollar down 3%. The dollar index up nearly 4%, and the VIX still very low, but up 20%. So just running through the charts, there's the FTSE All World Index.
Yeah, basically, Trump election, gone through the roof.
For no reason that I can fathom particularly. FTSE All Share.
Yeah, you see, going in the opposite direction because, if he imposes tariffs, of course, that's very bad.
The S&P, sorry, the Euro Stoxx 600 looking very much like the FTSE All Share. And the S&P 500 really liked Trump's. And one question that I read, is it just the removal of the uncertainty? Now they know who's going to be president. That's
yeah.
The Nasdaq Composite, which has done extremely well.
Yeah.
The Russell 2000 is actually looking quite healthy.
It is, but again, we'll go through some charts later. I mean, I think it's leapt kind of reflexively.
Yeah. The Hang Seng is not really sure what's going on with the Hang Seng, Keith, because it's very dependent on what China's latest policy is, isn't it?
Yep.
The Topics is actually virtually all of its gain came in the first 3 months of the year. Bitcoin doing very well and really liked. Trump has made favorable comments about Bitcoin in the past, so Bitcoin is very keen on the Trump victory.
Yeah. This is all as of last night, by the way.
And the pound against the dollar, basically, it's been around this 130 level for the last 4 months or so. And I think from memory, it's just trading within a big long-term range, isn't it?
Yeah. But, dollar's strengthened basically, and it's been bad for every other currency relative to the dollar.
Yeah, now the euro, I think, is in a bit of trouble with Germany being in trouble.
Yeah, but one of the things that's really mystified me this year, Richard, and when we show the charts of, the Eurozone economy and particularly Germany, there's Euro Stoxx 600 has been doing okay, so how come the earnings in the Eurozone, etc., are poor, but equity's been off to the races?
The dollar index, which almost hit 100 but didn't quite, and is now moving back towards the top of its long-term range, which I think from memory is about 107. The VIX, as I said earlier, very low, and the S&P 500 earnings up 14% over the last year.
Yeah.
And another correlation that has broken down is the ISM versus the stock market. So the ISM suggests the stock market should be significantly lower than where it is. Valuations stretched, as we've discussed many times in the past, and above dot-com levels.
Yeah.
And small investors are confident, very confident. Traders are record long, and the AI bubble is refusing to burst.
Yeah.
Difficult to know what to think about AI currently. The S&P 500 is the most concentrated it's ever been. Top 10 companies, percentage of the S&P market cap is 35% roughly.
Yeah. Frankly, this, in my books, this never ends well. It's just, when's he going to burst?
And Nvidia is continuing to reach new highs.
Yeah. Now, a few weeks ago, when we did last weekly, I was confidently predicting a double top based on my advanced chart reading skills. Well, there you go.
Never mind. It's unpredictable. The super microcomputer did something dreadful, didn't they? They're not doing what they said they'd do, or they were ordered to resign, it says there. So super microcomputer is doing the opposite of Nvidia.
Yeah, and they're Nvidia's third largest customer. But no effect whatsoever on Nvidia.
Yeah. Tesla, we've never really understood Tesla's share price.
Yeah, it just seems the height of just stupidity to me. But,
And the US market is looking expensive by any measure you care to look at. But it doesn't stop it from going up.
Exactly. Now look at Tesla. It's on a P ratio of 118.
Yeah.
It's not. Car sales are going nowhere. It's being outcompeted by the Chinese everywhere. I just don't get it.
Well, maybe Elon Musk will mandate the only car to be sold in the US is a Tesla.
Yeah, well, that could be true. Nvidia 63. I mean, these are huge PE ratios.
Yeah. And the equity risk premium is negative for the first time in 20 years. In other words, you can get more on bonds than you can on equities.
Yeah.
12 months expectations are for higher stock prices. Everybody's optimistic. And earnings outlook. So earnings growth expectations are actually beginning to fall. Although in the past, that hasn't really made much difference. In the past 10 years or so, that hasn't really made much difference to the US stock market.
That is true. Good point, Richard.
US small caps jumped on the election results, but more on hope, probably. Earnings estimates for the Russell 2000 have been falling, whilst it's been rising quite sharply. Again, quite a discontinuity there.
Yeah.
So US equities were down by the yellow arrow and very highly valued. And there is quite a strong correlation between valuation returns over future returns. So we shall have to see. We've been saying this for at least a year now, Keith, probably.
We have. But, this chart is 10-year future returns. So, let's see.
And we're only 2 years into this bull market currently. So there could be a long way to go. A long way to go.
There could be. But, the PE ratio, it's all been driven by PE ratio expansion. Let's see. Okay, thank you, Richard. On to commodities. And it's been a poor month for energy. In fact, frankly, it's been a poor month for everything apart from gold. Oil, over the past month, down best part of 5%. And it's now down on the year. Oil prices going nowhere, weak, great for inflation and for the world economy. Natural gas prices in UK and Europe have been rising seasonally with the cold weather and forecasts of more cold weather to come. US natural gas prices down 10% over the past month, but up 7.2% year to date. Coal fading again. Uranium, I'm afraid for uranium bulls, not looking great. Take you through some charts. So this is Brent going absolutely nowhere despite the continued tensions in the Middle East. This WTI, same story. Numbers specific to the oil market. Well, the reality is that the oil market's been weak despite actually crude inventory draws in the US. But US oil production continues to rise to a new high of 13.5 million barrels a day, as the EIA has been predicting, and that has come despite falling rig count. Shale drillers just get better, and Goldman see the risks skewed to the downside for the oil price. In particular, if the US poses tariffs, that will slow the world economy, slow demand. EU natural gas futures, been rising slowly throughout the year, well down from the post-Ukraine crisis levels, but compare them to pre-Ukraine invasion, that's not great. Same for the UK. US natural gas futures have been well up from their lows, but still not high. Coal prices going nowhere. Uranium, I'm afraid, fading again. Industrial metals, Richard.
So, aluminium up nearly 10% year to date. A mixed bag, aren't they, the industrial metals this year? So cobalt down 16%, copper up 10%, chromium down 8%, iron ore down nearly 30%. I think a reflection of the Chinese property market. Lithium carbonate down 25%, neodymium down 6%, nickel virtually unchanged, tin up 23%, and zinc up 12%. So some reasonable gainers and some quite big losers.
Yeah, but over the past month, and it's all these weekly gains, by the way, are since we last did a Portfolio Matters, so last month actually. But over that last month, commodities have generally fallen. So the market is worried about the world economy and, in particular, I suspect, Trump tariffs. Slowing manufacturing.
Yeah, good point. So we have aluminium, cobalt, copper, chromium, iron ore, lithium, neodymium, nickel, tin, and zinc.
So when you look at those charts, really, general weakness, I'd say, apart from a few selected commodities.
You're quite right, Keith, over the past few weeks, definitely so. So looking at precious metals. So last week or two, precious metals have been quite weak, no pun intended, particularly actually after the Trump election. But year to date, gold's up nearly 31% and silver about 30%. Platinum unchanged, rhodium up 5.6%, palladium down 18%. And then we have a chart of gold, which basically has been rising in a fairly straight line since March. And Chinese gold trading has exploded. So Chinese gold speculators have jumped into gold trading volumes on the Shanghai Futures Exchange. So a lot of enthusiasm there. And there's silver, which actually basically has taken off in price from the same time point as gold, but a bit more of a volatile process. Platinum really unchanged on the year, but quite volatile with it. Rhodium here, because it's a precious metal, used as a catalyst, and up a little bit on the year. And then palladium, this is interesting. So Russia, is it 75% of palladium is exported by Russia? I think there's a bit of uncertainty about Russian palladium exports. May have accounted for that spike up, but clearly it's dropped all the way back down equally rapidly.
Yeah. Okay, thank you, Richard. Finally on to rates, and it's been absolutely awful. So, I've been totally stuffed on my investments in long bonds because the UK yield curve has shifted very sharply up over the last month. And actually, you now look at the UK 30-year. The UK 30-year is above the 1 year. So the market is currently expecting that UK interest rates are going to, stabilize about 4.25% over the next 5 years on average. And we've got a positive yield curve. And I really did not believe this could happen when inflation's at 1.7%. So terrible for me. So whereas everyone else, and when you look at the equity markets, equity markets after the races, all of you made money. I've lost a load of money, and it doesn't make me feel very good about myself or anything, frankly. But getting over it. And back to doing the podcast. So this is the US. You see, unlike the unlike the UK, yield curve below where it was a year ago. UK above. Thank you, Rachel Reeves. So the term premium has turned positive once again due to rising uncertainty over the past future of interest rates and inflation. Lots of uncertainty at the moment. And bond market volatility has gone through the roof. So therefore, there is a uncertainty premium going into bond prices now.
Yeah.
And if you look at the past year, if you look at the past month, the rise in inflation expectations has been really extraordinary on, frankly, not much new information. And when you look at, as we showed you the inflation breakdown earlier, there's really no evidence of sustained inflation in the US. So that is all fears about Donald Trump, what he's going to do. Market is currently expecting US interest rates to bottom about 3.5%, and there's been no recession. So this is UK, huge rise. Look at that. End of August, UK 2-year, 3.6% is now at 4.4. That is an absolutely enormous rise. That's 20% rise. And that feeds through to mortgages. 10-year, highs for the year, 30-year, which I've got loads of, absolutely stuffed. So that is the new high for the year, new lows for my personal portfolio. And when you look at the 25-year view, they're pretty much the highest they've been in 25 years. During which time UK debts have grown. UK asset prices in the form of houses in particular have shot through the roof. And all that means that housing is unaffordable. So next week, we're going to talk about the impact of all this on young people. US 10-year notice was nowhere near as much as the UK. German, French. So concluding comments. Well, I'm afraid it's been a very rapid run through this week. We've got lots to cover. We will get back to regular bi-weeklies going forwards, and we'll hopefully take a bit more time going through the data. But I hope you had got a good picture of where we are now. The bottom line is where we are now is increasingly irrelevant. What matters is where we're going to be and what Donald Trump is going to do. If he imposes tariffs on the rest of the world's imports, that will have big effects on primarily on activity in the form of GDP growth, but also potentially on inflation. Watch this space. We will hope to keep you informed of the state of the world going forward. Thank you all for your continued support. Now, my portfolio, I'm going to stop reporting like how I'm doing. Take it from me, it's terrible. Worse than you can probably possibly imagine. And but if you buy index-linked gilts, you now get 5% pretty much tax-free, which is the equivalent of 8% in the bank, given if you're a 40% taxpayer. So the reality is I've lost fuckloads of money, like mark to market, but I can hold these for a long time. I will. And thank you to Dan Leeds and our Discord members, because I bought loads of REITs that are yielding between 6 and 7% and 8%. So actually, my income means I've got absolutely no worries. It's just that I've got a lot of self-imposed losses and stress, which I need to get over. But, thank you to everyone for their support in these difficult times. It is my own stupidity, and I like taking a lot of risk. Sometimes I get it totally wrong. This is the worst one. So, well, next time when I see an opportunity, will I go all in like this? Well, that could be a lot, a long way in the future. And but frankly, I don't think I've gone through any sort of character change. So the likely answer is yes. Richard, how are you doing?
Well, like you, Keith, I think it's best not to report one's personal portfolio, actually. So I'm going to, I have, as you know, I've really been saying very much for a few months. So I'm going to continue with that policy. I think it's not really what we're trying to do on this podcast.
Yeah.
So yeah, I'm with you on that.
Okay, but what have you made any changes? I bought loads of REITs, and the idea there, as we've talked about previously, is that if if interest rates come down, spoiler, they haven't, then the NAV rises and the discount reduces. Therefore, you get this double whammy. But so far that hasn't happened. But they haven't performed too badly, and in the meantime, you're getting between 6 and 8%, depending on
Yeah.
which one you've got. So I'm quite happy with that. I can live with that. And
I haven't made any changes to my portfolio. It's still where it was. Basically, I've done a little bit of tweaking around the edges, but nothing very much. And I'm anticipating not making any major changes for some months to come. Famous last words.
yeah, and actually, as the one thing I have done is I sold all my petrometad, which is I bought a small oil explorer in Mongolia. I just thought, why am I doing this? It's like it's time to buy some yield. I don't need to be buying,
Yeah.
I was very, very unimpressed with the fact that they, said that all their permitting issues were over, and then the moment they did the rights issue, they announced that actually they needed another permit to do the construction. I thought this is endless. So I've sold that at break even, and I put it all in REITs, earning 7%. So, sensible investment policy to balance my idiotically large position in gilt. Anyway, we're back. Please, can you provide some feedback? And we'll be doing this every couple of weeks going forwards, because it does take up a lot of my time, and I would like to do some other things as well as portfolio matters. So in the meantime, thank you very much to Richard Wheater and to all of you. So please, can you press like and subscribe to the channel? And it's goodbye from Richard Wheater.
It's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.